Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
Financial Survival Network is presented to you by Regal Assets. Buy and sell physical gold and silver through your existing retirement plan, 100% tax-free with Regal Assets. If you want to include physical gold or silver in your existing IRA or old 401k, request your free investment kit, which was recently featured in the Forbes and Smart Money Wall Street Journal magazines. Call toll-free 855-678-6620, 855-678-6620, or visit regalassets.com. Bernard Baruch once said, "I got rich letting the other guy make the last 10%. And I think we're looking at a similar situation right now. I've got Charles Biderman on the line. You might be listening to us and you might be watching us. And Charles, how are you?
Good. How are you?
Doing good, doing good. So do you agree with that statement that Bernard Baruch said that he got rich letting the other guy make the last 10%?
Well, right now I'm fully bearish long term, and I definitely think that at some point the rigging of the markets has to become undone, and the markets will go to where reality would have it. Home prices are down half from their peak. If stock prices went down half from their peak ultimately, but till we get there, the powers that be, the central bankers and the like, are printing as much money as possible to keep stock prices as elevated as possible. The only thing that's working that they're able to do is keep stock prices up for a while. I think that they're not going to be able to levitate stock prices forever, particularly since the underlying economies are not growing. So on the one hand, you want to be short. On the other hand, you want to be safe and short. And so how do you do that? Well, that's the secret to being a successful long-term investor, I say. And in my Biderman's market picks, what we've done is the portfolio, while it's 32% short, it's short emerging markets, Europe, and the big banks. It's also long 18%. The stocks include Apple and Amazon and Salesforce.com, Whole Foods, and TrimTab's Float Shrink ETF, RETF. And then we're also about a quarter long gold. We recommend buying 1 ounce bars. And a quarter long inflation protected securities. So since that at the end of May, when we started that, the market, the S&P is up 5%. That portfolio is only down, is down less than 1/10 of 1%.
Really?
And at some point, the market's going to crash. So I want to be short, but I don't want to be losing money while I'm waiting.
That's important because, like we were saying, there's nothing worse than being right at the wrong time. And people who go all in because the chart appears to confirm their theory isn't necessarily going to work out well. Let me ask you a question. Are you bearish? I know you're bearish on a fundamental basis, but what about cycles cyclically, where we are in terms of the last market crash and perhaps the next?
Well, right now we seem to be on a QE cycle. And for what I mean by that, when QE1 was announced or extended in March of 2009, between then and March of 10, when QE1 ended, the market was up 50%, the S&P 500. Then it's declined 20% till August when the Fed announced QE2. So with the announcement of QE2, the S&P climbed 40%. Until it's topped out. And then when it topped out, then it declined 20%. And then the Fed announced QE3, Operation Twist, or Twist and Shout.
Yeah, that's what I called it too.
And then the market's up 30%. Now it gave back to us like 6, 7. Now we're pretty much back to the 30%. So based on my analysis of Fed action, they are unlikely to announce another round of easing. Whether it would do anything or not, that's a different question. But they're unlikely to announce another easing until the market drops 20%. Why are they? I mean, all they can do is help the market. The market's going up anyway. given that people are expecting the easing. So as long as, it's like a game of kicking the can down the road. But the problem is there is no end of the road.
Yeah.
Like the
Yeah.
real problem is if, like in the beginning, when the Fed printing nonsense started, the Fed printing was supposed to be a bridge, supposed to provide liquidity to the system, and then at the other end, economy will revive, growth will revive. We'll cut government spending, cut waste. Europe was gonna, the initial plans to save Europe included the governments would get lean and mean, remove restrictions on business activity, all that, and none of that happened. None of that happened here.
Yeah.
All right, we got this safety net. Screw with actually making the economies work. So now we have situations where the income generated by the developed world, Europe, United States, Japan, the incomes developed is insufficient to generate sufficient tax revenue, tax income, to be anywhere near what current government expenditures are, let alone exponentially growing future government expenditures based on entitlements, let alone the trillions of dollars of existing debt, totally unserviceable by the current rate of economic activity. And we think that, oh, Draghi and Bernanke are going to print money. How long we're saved?
Yeah. Yeah. So, like your old buddy Tyler Durden said, we've got a tab for the past 30 years of profligacy, and they're all trying to figure out who's going to pay it, but it isn't going to get paid. And we're kind of past the point of redemption. So what does that leave you with as a long-term investment to protect your wealth, really?
Yeah, well, that's why I say a quarter gold, a quarter inflation protected securities. We're short. And, long term, I think tech is where it's going to be at, so to speak. We have a vibrant global broadband-based business environment that is being hindered by stupid government activities, laws, rules, and those governments are self-destructing. So I think in the new world, it'll be online-based, social media-based, lots of prosperity and growth there once we get rid of the shackles of the existing system.
Yeah, and eventually the system is going to collapse from its own weight, collapse of its own weight. But when you talk about market rigging, is there a market in the world, do you think, that isn't rigged at the present time, a publicly traded securities market?
Probably not. Probably not. They're all, look, in every market, the house has an advantage, whether it's the corner market, whether it's the stock market, whether it's the foreign exchange market. The house and the foreign exchange are the central banks. The house and
Hmm.
the stock market are the companies. But now the government has taken over this from the companies and saying that, hey, we're going to give you companies money at no cost, and you can use that money to buy back shares, and that has to be good for you, right? So in essence, that's what's the money the Fed has created has gone, a lot of it ended up on balance sheets of public companies, and they're using that money to reduce the number of shares, which since individuals are selling stock, pension funds are selling US shares, hedge funds are selling US shares, individuals are selling US stocks. How does the market go up if everybody's a seller? Well, the Fed's giving companies money, costing them nothing. They can earn nothing on it. So they're using that money to reduce the trading flow to shares,
Right.
putting money into the system about $1.9 billion a day for the past year. And that's why the market's been so strong. Now, you know, I just I think there's been a spike of buybacks recently. I think it's maybe a one-time thing, and that as the economy keeps slowing in growth based on the data we track, I got to think that buyback activity is going to slow, and at some point has to implode on itself. The only question is when.
Yeah, that's always the big question. And the one uniform response I get from everybody who comes on the show, and it doesn't matter who they are, is eventually. Nobody can tell you when, because systems are strange that way. It's like the battleship making a U-turn, and it going of its own momentum. and eventually it runs out of momentum, and that's when you have the crash, I think.
And there is one truth that afterwards everybody will have, of course, seen and predicted it.
Well, at least you and I are on record here. We've got
We're not
documentary
saying,
evidence.
we don't know a date or a time or
Yeah, well, if we
I
say it,
don't.
stop clock, you just say it next month, next month, next month, and then you don't have a particular date, but it's like, wow, he did it. He would said it was next month, and next month came, and the market crashed out. So it's just disheartening to me, Charles, that the markets are not performing their designated role, which is price discovery and allocation of capital. Instead, they've become a kind of billboard for how good the administration in power is doing in managing the economy. And I don't think they have any credibility left on that score either.
Well, I look at the stock market a bit differently. I see that the current market value of about 19 trillion of all publicly traded, the market value of U.S. stocks, just U.S., and that's up from 1 trillion in 1982 before the bull run began. Okay, it did peak at 22, so we're down, 12, 13% from the all-time peak. So anyway, my point being that 18 trillion of wealth has been created. Who did it go to? It went to people who own stocks. So if you were a stockholder or someone who managed portfolios or whatever, you've done phenomenally well over the last 30 years.
Yeah.
And so there's a certain amount of entitlement that they deserve to be this rich and that it's good for them to have this money. So I really think that the one area that's going to downsize big time in the future will be the number of people managing other people's money as, let's say, the wealth returns to the mean.
Mm-hmm.
Home prices are down 50% from the peak in 06, 07. Let's say the according to the Federal Reserve Z1, to be more accurate, the home equity of all Americans is down about 50% from which is
Sure.
the market value minus all mortgages minus the peak level sometime in 06. And so yet stock prices are down 15% from the peak. If it wasn't for all the manipulation, stock prices would probably be down 50%, which means we're going to probably go back at some point in time to the March 09 lows.
Yeah, that makes sense because, like you say, it's going to revert to the mean, except because they've kept it supported for so long. When it does go down, it could conceivably go way past the mean
it could.
For a while.
I'd say March 09 is when the Fed started rigging, that's where the market was.
So it could easily go well below that.
And it could go below that, but if it does go below that, I'd probably be a buyer.
Mm-hmm. So, and the metals are looking good, and you're just thinking that the house of cards is going to collapse, basically.
Yeah. At some point, I mean, the banks are really worthless. There's no question. I love it when the Draghi, we will save the euro. I mean, so when a guy says that in that position, that means there must be significant doubt that the euro is going to be saved.
Yeah.
So it's not like, come on, you can't even begin to suggest that, right? I mean, no, it's obvious that everybody thinks so, and they're fighting. The powers that be want to see, the central bankers. What is he? We're going to do everything we can. No, we're not going to do everything we can. We're going to be underperform as man. What is saying that we're going to do everything we can to save the euro mean? What It's nonsense.
Yeah.
They can't do anything. They can't get these governments, these countries to work economically. They can just talk their book, hope that they can kick the can far enough down the road so they can retire with a full pension before the reality hits.
Before somebody else has got to pay for that pension, which is the whole problem, which is why you're seeing cities in California, lining up for the bankruptcy court, which is probably a good thing. The only thing is they're not yet attacking CalPERS. They're not attacking the pension obligations, which are the main obligations that are causing them to collapse in the first place. But they're scared of CalPERS,
Well,
And
that's because CalPERS won't let them put the real number. I mean, they're in California where I am, obviously,
sure.
8% pension funds are assumed to earn 8% on their assets, and they're earning one,
Hey,
two, maybe. So the reason that they can't reduce this number, because right now in California, pensions as a percentage, pensions payment by the state as a percentage of total budget, I'm giving approximation, or let's say $7 billion. And if it were to be marked down to 3%, they would have to add another $10 billion to state payment to pay for
mhm,
current pension expenses. And this is in a state that's already has a $10 billion deficit
that they admit to.
that they admit to. So the point is that they can't admit to what the real deficit on the pension is, because the people would revolt and say, we're not going to give you con men these pensions that you think that you
Mhm.
deserve, that you signed an agreement with yourselves to give yourselves.
Hey, and let me just tell you a quick anecdote. I was at a town board meeting in my town, wealthy town in Westchester County, New York. You know, you know it. And
Town?
the town of North Castle. Okay.
Okay.
IBM is headquartered there.
Yep.
It's a
Plush.
well-heeled
Plush.
bedroom community. And I try to explain, because they're cutting the retiree health benefits, especially for the part-time members of the town board who were elected and awarded themselves free lifetime health benefits, of course at the taxpayers' expense, 22,000 a year, and these people never worked a full day in their lives for the town. So I helped these guys, a couple of them get elected, and they immediately 6 months later got rid of this. And I got up and I said, "You're a bunch of parasites." And I explained to him that the New York State pension system is bankrupt. And this guy gets up, who works for the county of Westchester, and he tells me it's not bankrupt. They got a 5.9% return last year. Forget about the pathetic returns they've gotten 3 years before that. Forget about the fact that they're projecting 8%. And New York City had a hemorrhage because they lowered it to 7%. So, okay, they had a good year last year, maybe, assuming they didn't cook the books and they didn't write stuff down they were supposed to. So, supposedly it's 6%. They still fell behind on a good year. The system is insolvent. It's a
I,
weekend at Bernie's. No one will admit it but you and me, Charles.
I got a good story to conclude with that maybe even as good as yours. In Sonoma County, 2 years ago, there was $100 million shortfall for the pension fund. So what they did was they borrowed $100 million at 8% to put into the pension fund, which they expected to earn 8% to plug the gap.
Uh,
And so right after they did that, the guy who was the treasurer at the time, he retired with a full six-figure pension for life. Meanwhile, on that 100 million they sold, they earned 1%. They're
huh.
paying 7%, and they're estimating 8% on future earnings on the total plan, and they're earning 1%.
Yeah, well,
And the guy retires with his full pension right after putting this deal together.
it's pathetic. And what everybody forgets is, if you're increasing a cost 7% a year, that means it doubles in 2 years. I mean, in 10 years, right? You have the
Yep,
rule of
7%
70,
in 10 years.
right? 70. So it's
Yep.
gonna double in 10 years, and then you go up 10, 12%. And I'm talking about the demands on the system, not what the system's generating. The demands 7%, 10, 12, 15% a year. It's going to go bust. And then we're going to be left with liquidation, will be the only feasible way, where everybody kind of gets treated equally and they all get cashed out of the system and it's shut down. And then we go on to grow your own retirement, basically save your own retirement. That's the only way in the long run. The numbers are just too gargantuan, and the system cannot hold up against them. It's impossible.
Yep.
So, on that pleasant note, Charles, to find out more about your publications, Trim Tabs, tell us where we go.
Trimtabs.com blog. We have a weekly newsletter for retail, $260 a year. We have a trading model that is pretty good if you like to trade. $30, $60 a month for that. Videos are there, and come watch, come comment, come laugh, come scoff.
Yeah, well, a whole lot of scoffing going on. Charles, thanks so much. And financialsurvivalnetwork.com. I've interviewed Charles before, as well as other world financial luminaries, and it's always a pleasure. Charles, we'll talk to you again soon.
Yes, sir.